Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Monday, June 8, 2026. We're Elena and Marcus.
Thanks for joining us.
So today we are looking at a market that is deeply confused. It's suffering from this profound cognitive dissonance.
Yeah, that's a good way to put it.
If you look at one side of your portfolio today, equities are partying. I mean, they're acting as though the global economy is achieving this perfect, frictionless, soft landing.
Right.
But then, if you look at the other side, the bond and commodity markets are screaming that a persistent, sticky inflationary regime is already here.
It's right on our doorstep.
Exactly. So over the next 15 minutes, we're going to dissect the three critical themes emerging from today's proprietary updates, just to show you exactly how these contradictory signals are colliding.
It's a lot to unpack today.
It really is. First, we will examine the violent repricing in global rates. This was triggered by a blowout U.S. jobs report, which just pushed the 30-year Treasury yield past a critical threshold.
Yeah. Second, we're going to explore a highly concentrated technology rebound. It's being led by just a few select semiconductor names, which is actively masking deep fragility underneath the surface.
It's a very narrow market right now.
Yeah, extremely. And third, we must address the stubborn geopolitical premium baked into hard assets, where crude oil is holding its ground despite diplomatic de-escalation in the Middle East. This is your high-level briefing on the mechanics driving today's tape.
It really is a session characterized by internal contradictions.
Yeah.
I mean, these signals just cannot coexist over the long run. Synthesizing these divergent signals, understanding why risk assets and fixed income are telling you two completely different stories about the future cost of capital is the core mission of today's analysis.
Moving to today's data, the most significant macro driver we are tracking in our daily desk data is the aggressive, really violent repricing of Federal Reserve policy expectations.
Yeah, it's been severe.
And this entire shift stems directly from the May jobs report shock we saw late last week. We tracked 172,000 jobs added versus the 85,000 expected, which is huge.
Right. To put that in context, that is not a modest beat. That is a fundamental alteration of the institutional consensus regarding the underlying temperature of the U.S. economy.
Yeah, it changes the whole math.
Because of that data point, we are seeing major dealer desks actively capitulate on their rate cut forecasts. Today, BNP Paribas formally abandoned their on-hold call. They are now projecting that the Fed will actually resume hiking rates starting in December 2026.
The magnitude of that institutional pivot is, well, it's severe. If you rewind just 1 week, the entirety of the market debate was focused on pinpointing exactly when the Federal Reserve would deliver the next easing cycle.
Or the timeline for cuts.
Exactly.
Yeah.
Now, with labor markets running this hot and inflation expectations remaining incredibly sticky, the pendulum has swung violently back toward tightening. You can see the physical manifestation of this panic in today's specific domestic rate moves. The 10-year Treasury yield climbed 3.4 basis points to settle at 4.566%. And even more notably, the 30-year yield officially breached that psychological 5.038% level. When you see the 30-year crossing 5%, it forces a mechanical recalculation of asset valuations across the entire financial system.
Let me jump in here because to make sure we have the mechanics clear for you, let's apply the first principles rule here.
Sure.
In today's data deck, we see the 10-year, 2-year spread steepened by 1.7 basis points. Can you provide a quick, simple explanation of how this specific bear steepening curve functions? And more importantly, why does long-term rates rising faster than short-term ones matter so much to the regular investor?
Yeah, it's a great question. So, a bear steepener occurs when long-term interest rates are rising at a much faster pace than short-term interest rates.
Okay.
The word bear is used because bond prices fall as yields rise, which is, bearish for current bondholders. For the past couple of years, we have been discussing an inverted yield curve, where short-term rates were higher than long-term ones.
Which typically signals an impending recession, right?
Correct. But what we are observing today is the exact opposite mechanism. Bond investors are demanding significantly more compensation, a higher risk premium, for locking up their capital for 10 or 30 years.
Because they're worried about inflation.
Exactly. They are demanding this premium because they perceive a persistent, higher for longer inflation risk that will erode their purchasing power over time. For the regular investor, this is the bond market loudly declaring that the era of cheap capital is officially over.
It's done.
Yeah. The long-term cost of borrowing to fund governments, to finance corporate expansion, and to underwrite everyday mortgages is going to remain structurally elevated for the foreseeable future.
And if we connect this to the international rates picture, the global context is equally striking. I mean, it is not just a domestic phenomenon. Money markets have now fully priced in a 25 basis points hike by the European Central Bank.
Yeah, bringing their deposit rate to 2.25% for this coming Thursday.
Right. That makes the ECB the first G7 central bank to hike rates in direct response to the current energy shock. But what stands out to me in our latest run of data is that they are doing this while the Eurozone's first quarter GDP was revised down to a contraction of 0.2%.
It's tough.
I mean, hiking into a shrinking economy seems counterintuitive.
It is highly counterintuitive, you know. But it highlights the sheer panic among central bankers regarding energy-driven inflation. The ECB's primary mandate is price stability, not economic growth.
Right.
When energy prices surge, it often causes the local currency to depreciate, which means importing even more inflation. Central bankers are terrified of repeating the policy errors of the past, where they let inflation become entrenched in the psychology of businesses and consumers.
So they have to act.
Yeah, but by forcing a 25 basis points hike here, while growth is already negative, they risk choking off whatever fragile economic activity remains in the European industrial base. They are choosing to induce a severe economic slowdown, kill inflation, rather than letting prices run hot.
Understood. That macro backdrop leads us directly into how equities are reacting. And the narrative connection here is stark. Rising long-term yields are effectively forcing the equity market into an incredibly narrow, fragile leadership profile.
Yeah, very fragile.
We look at the index performance today,
Yeah.
and the NASDAQ 100 rose 1.58%. On the surface, if you just glance at your screen, that looks like a robust, healthy recovery.
Sure.
But that headline number heavily masks the broader underlying market weakness. The equal weight S&P 500 was completely flat for the session, and the Dow Jones actually slipped 0.16%.
The divergence you are highlighting there between the cap-weighted indices and their equal-weighted counterparts, that is a textbook signal of market fragility. In a cap-weighted index like the standard S&P 500 or the NASDAQ 100, the largest companies dictate the majority of the movement. When the equal-weight index is flat while the cap-weighted index surges, it tells us that investors are actively abandoning the broader economy. Right. They are fleeing companies that rely on traditional bank financing and hiding in a very select handful of cash-rich, mega-cap technology names. The underlying breadth of the market, the actual number of individual stocks going up versus going down, is deteriorating rapidly under the weight of those 5% 30-year Treasury yields.
We certainly saw massive single-stock moves driving that NASDAQ performance today. Intel surged 11.19% on reports of a 3 million-plus AI chip order from Google scheduled for 2028 delivery.
Yeah.
And that was alongside news that NVIDIA is evaluating Intel's advanced packaging as a backup manufacturer. We also saw Micron jump 9.87%. But, you have to contrast that domestic tech euphoria with the international data from today's proprietary updates.
The global picture is very different.
Exactly. The KOFPI plummeted 8.29%, triggering a market-wide circuit breaker. SK Hynix, which is a major foundational player in the memory space, plunged 7.7% today. And what is most surprising is that this plunge happened despite news of a new multi-year infrastructure partnership signed directly with NVIDIA.
The contrast between the U.S. and Asian semiconductor response is incredibly telling because it exposes the underlying positioning and flows beneath the surface of the market.
Right.
When we dive into our latest run of prime brokerage metrics, we see that hedge funds were actually net buyers in macro products, stepping in to sponsor the take at the fastest pace in months.
So they're buying the dip.
Yes. They are operating with an overall gross leverage of 320.6%. But on the other side of that trade, retail investors are facing immense structural pressure.
Yeah, tell us about that.
Well, there is currently nearly $100 billion of levered semiconductor and hardware exposure held globally by retail participants. When an index gaps down hard, as we saw with the KOSPI circuit breaker, those levered retail positions are mechanically forced into margin calls.
Right. The brokers need the cash.
Correct. Brokers demand immediate cash to cover the falling value of the collateral. If the retail investor cannot produce the cash, the broker automatically liquidates the position at the market price.
Which just drives the price down further.
Exactly. It creates a self-fulfilling feedback loop or an elevator down. The institutional crowd remains cautious and highly selective, while the retail cohort is attempting to buy the dip in a dangerously leveraged manner.
Well, I want to push back on this infinite AI growth narrative that the market seems to be blindly buying into, and I'm pulling directly from the task per watt debate highlighted in today's data deck.
Okay, let's hear it.
If we look back at the early internet, we paid premium prices for basic bandwidth and connectivity.
Yeah.
But eventually, infrastructure scaled, and bandwidth became a highly commoditized, cheap utility.
Yeah, became invisible.
Right. And right now, we are seeing Meta signaling massive new equity raises specifically to finance their AI infrastructure buildouts.
Huh.
The marginal cost of AI capital is shifting away from cheap debt, because yields are at 5%, toward highly expensive equity dilution.
Right.
So are we not simply transitioning from a phase where we pay premium frontier prices for AI reasoning into a commoditized environment where useful intelligence costs little more than electricity?
That is precisely the structural debate the market is ignoring in its violent rush back into tech today. The market currently presumes that all incremental compute power will be consumed by highly profitable, centralized data centers focusing on frontier artificial general intelligence.
Right, the big mega models.
Yeah. But as open source models proliferate and become more efficient, the basic foundational level of usefulness becomes nearly free.
Exactly.
If the vast majority of daily computational tasks can eventually be completed at the edge, meaning on local devices, phones, or older hardware, at the mere cost of the electricity required to run them, then the terminal value of these massive infrastructure buildouts is severely mispriced.
And that ties right back to Meta.
Yes. When companies like Meta have to tap public equity markets for tens of billions of dollars to build data centers, it proves that the capital intensity of this trade is becoming a severe burden. Equity dilution mathematically reduces the future earnings per share for existing stockholders.
It's expensive capital.
Very expensive. The road to artificial general intelligence is incredibly long, and if useful intelligence becomes a low-margin commodity in the interim, the current stratospheric valuation multiples on these hardware providers will face a severe reality check.
On that point, the immense power requirements of this AI data center build-out bring us directly into the macroeconomic inflation fears and the physical constraints of the energy markets.
Yeah, you can't build these without power.
Exactly. And we tracked a major geopolitical catalyst overnight, with kinetic escalation and de-escalation in the Middle East. Israel struck Iran's Mashhar petrochemical complex, which was followed immediately by an Iranian missile retaliation.
Right.
Then, following intense diplomatic appeals, we saw a subsequent halt in attacks.
Despite that late-day ceasefire, though, and the calming diplomatic rhetoric, the pricing mechanism in the commodity markets is sending a very clear warning. Brent crude is holding stubbornly near $94 a barrel, and WTI crude remains over $91.
It barely budged.
Yeah, and the reason the oil market is refusing to sell off on this de-escalation news is crucial to understand. The market is looking entirely past these day-to-day episodic missile strikes. Dealer desks are pricing in the structural supply disruption risk of a Strait of Hormuz closure.
So it's not about the single facility that was struck.
Not at all. The geopolitical premium embedded in a $94 barrel of oil is no longer about whether a single physical facility is struck today or tomorrow. It is about the sustained economic misery of physical rerouting, higher shipping insurance premiums, and the realization that broad stabilizing diplomatic deals remain exceptionally far apart.
The structural risk is just baked in.
Exactly. The baseline distribution of outcomes for global energy supply has fundamentally shifted towards scarcity.
And we're also seeing this persistent premium reflected in the hard assets.
Yeah.
Gold remains highly elevated at $4,330 an ounce, fully cementing that structural geopolitical risk premium into the plumbing of the financial system.
Yeah.
Furthermore, copper is firm today at $13,590 per ton. That copper strength is directly supported by the massive AI data center build-out we just discussed. Those physical facilities require unprecedented amounts of copper wiring for power distribution and complex cooling infrastructure.
Correct. The copper pricing perfectly bridges the gap between the ethereal technology infrastructure narrative and the physical constraints of the commodity markets.
They collide right there.
They do. You have a scenario where the physical inputs required to sustain the tech sector's projected growth are becoming increasingly expensive due to a collision of demand shocks and supply chain vulnerabilities. You cannot build a billion-dollar data center without thousands of tons of copper.
Right.
When you combine 94 in oil with $13,590 copper and $4,330 gold, you have a commodity complex that is entirely rejecting the notion of a smooth, disinflationary economic glide path. The physical markets are telling you that the materials needed to build the future are scarce and expensive.
Indeed. And that brings us to the final synthesis of today's proprietary updates. There's a glaring contradiction in today's data deck that we need to connect for you. On one hand, the VIX collapsed 12% today, down to 18.92.
Which is low.
Right. The VIX measures expected market volatility, so a drop of that magnitude suggests extreme complacency and a violent rush back into the safety of tech equities.
Yeah.
But simultaneously, we have these massive moves in physical commodities, with oil holding $94 in rates, with the 30-year Treasury crossing 5%.
Those specific signals cannot coexist over a long-term horizon. A VIX sitting at 18.92 implies an equity market that is expecting stable growth, contained risks, and a predictable central bank response.
Basically a perfect setup.
Right. But 5% long-term yields and $94 oil tell a completely different story. They point toward a stagflationary adjacent regime where economic growth stagnates, but prices continue to rise.
Which is the worst of both worlds.
Exactly. What this means for the broader economic environment is that the fixed income and commodity markets are definitely not pricing in a clean, engineered soft landing. Instead, they are signaling an environment of persistent inflation where central banks, particularly the Fed and the ECB, are dangerously behind the curve.
Right.
The equity market's narrow reliance on a few semiconductor names is a facade. It is actively masking the severe strain that elevated borrowing costs and high energy inputs are placing on the broader global economy, from manufacturing to consumer spending.
It sets up an incredibly precarious environment for your portfolio and broader capital allocation. So I want to leave you with a final concept to mull over regarding the intersection of these themes.
Okay.
If the task per watt commoditization of AI proves true, and the cost of capital continues to shift away from cheap debt toward highly expensive equity dilution, as we are currently seeing with Meta's infrastructure funding, will the foundational mega-cap tech thesis begin to crack, just as global borrowing costs reach their absolute zenith?
It is the defining question for the next quarter. If the operating margin profile of the artificial intelligence sector compresses into a utility-like commodity, exactly as the cost of financing those operations peaks, the resulting valuation recalibration across the major indices will be severe and broadly felt.
A rapid recap of today's core takeaways before we close. We saw global rates aggressively repricing higher, with the 30-year Treasury breaching 5% following a blowout jobs report.
We also tracked a very narrow semiconductor-led equity bounce that heavily masked broader market weakness and retail margin pain.
And finally, we detailed the structural geopolitical premium holding oil near $94 despite diplomatic ceasefires.
Exactly.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.